Well, hello everyone. Welcome to After the Close. I just heard the bell ring, so the markets are officially closed for the day. Scott in the chat is saying it seems like it should be Friday, and all I can say to that is here. I brought out my flags today, my Canadian flag and my American flag. I just wanted to be sure. For those of you who follow both James and I, he always teases me about saying Canadian flag. And I do say flag like bag, like brag. And, I just thought it was a good day to show both flags on this anniversary of September 11th. If you've never seen the play Come From Away, where 9,000 residents of Gander, Newfoundland took in 7,000 people who unexpectedly came to visit for 5 days. I'd highly recommend that you check it out. In fact, I think that they recorded it and you can watch it on Hulu if it doesn't come to a town near you on a stage. But it just shows kind of the resilience of the human spirit and how overridingly most people are kind. In any event, today we're talking after the close, and what this class is really about. It's really designed for people who have maybe a job and they can't look at the markets during the day, or they have a job and they have a family and they go, as I did for a long time, at the end of a work day, they're driving in circles with kids, getting them to soccer and dance and swim team and lacrosse and hockey and, whatever, your kids' sports are or programs are. Maybe it's dance and theater and all of that. And then, at 9 o'clock at night, they get to sit down and look at their investments. And there are many people actually in that camp where, they may want to be the manager of their own financial destiny, but during regular market hours isn't a possibility. So we're going to talk about two things today. One, how you might, choose to invest, and two, what if you have a portfolio and you have a job, but you want to be able to generate some extra income because there's a little too much month at the end of the money, and you've got some money invested, but you'd like to be able to generate some income with it. So we're going to talk about two potential ways we can look at investments, one for a longer term investment, one for, a shorter term perspective. So that's what we're going to look at today. Please know that everything that we cover in this class, it's for informational purposes only, none of it to be construed as a recommendation to trade any particular stock, in using any particular strategy. We are going to look at a buy right covered call today. That is an option, and know that options carry a high level of risk and aren't suitable for all investors. We will use the paper money software application on the thinkorswim desktop platform, which is a brilliant place to learn, to become familiar with your trading strategies, how to use the platform. You can practice. It looks like, smells like, feels like real money, but it's not, which is kind of handy. As a place for you to learn. One of the nuances or differences between the platforms is that the paper money platform will never assign a short option early. So if you sell a covered call and it ends, the stock goes through your strike, you'll never be called out early in paper money. That can happen in a live account. Also, stop loss orders, just a reminder, they aren't a guarantee that you'll get out at the price you requested. So I've already gone over kind of what we're going to talk about today. So let's get out and just do a super quick look at the overall market. So, in February and March, Chicken Little was out running around doing laps. And then we got to the beginning of April, and it has been really a pretty amazing run. And the market hit a new all-time high today. The S&P 500 did, up 36% from those February lows, up 11.5% year to date. So it's hard to look at the market as anything other than bullish right now. And the NASDAQ looking pretty similar. It too hit a new all-time high today. Of course, the NASDAQ, our tech-heavy index, no financials, up 45% from that low. and up 13% year to date. When we look at the Dow, DJX, it too hitting a new high today. And the Russell, which has been kind of the leader of the pack over the last 90 days, it's not hitting an all-time high, but it's certainly hitting a year-to-date high. And if we go back over the last 3 years, it's pretty close. It's getting close to that high. And then how about our volatility index? It's sitting now under 15, which when we look at, let's look at, a 1 year chart, that's at the low end of the range of where our volatility or fear index has been hanging out for the last year. And if we come to sectors, and this is a public watch list, if we come to sectors and indices and say, well, which sectors have been strongest? And I'm bringing this up for a reason. Healthcare is the leading sector, followed by communications and then consumer discretionary over the last 4 weeks. Now, if we look at the last 3 months, communications and technology leading the pack. And in fact, we look at technology, close to an all-time high, consumer discretionary, very bullish, communications, close to an all-time high as well. And then if we look at healthcare, the leading sector in the last month, but it was kind of down here. It's been on the struggle bus. It's only up 1.4% year to date. And was kind of trading in this range, from, May through actually the beginning of September. But looks like it's kind of broken this diagonal resistance line and is now using that as a support line. And so if we have a portfolio, and I actually used to teach this class, and so if we come, we have this $500,000 example portfolio, and we have a number of positions in it. And so if you're in this boat where you're not just starting out, where you already have some positions, one of the things you may want to look at is, what have I already invested in? Well, this is an industrial stock. Then we've got AVGO, which is part of the tech sector. You may say like, hey, this is kind of cool how you've got the sector listed here. How do you do that? Well, you do that by coming here to your sprocket and then just type in sector. And then hit add and okay. Now I've already added sector to these. So we can see we've got one stock in the tech sector, AVGO. And that's it. And the tech sector is the biggest component of the NASDAQ also. Oh, excuse me, the biggest component of the S&P 500 as well. So to have only one stock in the tech sector, in our portfolio might be a little light. And we have how many stocks in the healthcare sector? That would be none. And so if we're looking to add a position, could we perhaps look at something in the healthcare sector and or the tech sector? So we're going to come and look at UNH. Now, UNH, was hanging out with Humpty Dumpty for a while there. Like, it's down 30% year to date. But as a technician, if we look at this, we can see what kind of pattern. I know that some of you will know, and I think I actually posted a picture of this on X. And if you're not following, I've got James Boyd with us in the chat today. He is a prodigious poster on X. You're going to want to make sure you follow him, James Boyd CS, and then Barb Armstrong CS. But we have this inverted head and shoulders pattern. And it goes from here around 235 to 328. That's almost $100. If I take 328 minus 235, this is a range of $93. And so some technicians might say, well, I'm going to take this 328 and add $93 to it, and then I'm going to make my target 331. Now, some people might also use a Fibonacci tool if they wanted to have a target. And some might just say, you know what? This stock has a PE ratio of around 14. It does pay a dividend. And if you don't have this on your chart, I do have the script for it posted to the top of my X feed. You can also get that information by coming here to the trade tab and just hit this little drop down, and it'll tell you yield of 2.5%, PE ratio of 15.3, which many investors would consider to be in that value category, which a PE ratio of 15 means that for every $15.30 you invest, this company generates a dollar of profit, which is pretty healthy. A lot of growth companies, well, you know, some growth companies aren't actually making money at all yet. And it's their intention to get there. So if we said, okay, this stock trades at $353, our position sizing rule for this says that we can only buy a position up to 5% of the account value. So if we said, okay, there's 518,813 times 0.5%, that's we could have a $26,000 position. That would be our max position size. So we're going to say, okay, 26,000 divided by 300, and I'm going to round up to 354. We can buy 73 shares. Now, where might we put a stop? Because the second part of our position sizing rule is that we don't want to risk more than 0.5% on any one investment or trade. And so if we look at this 328 as a potential support level, we could put a stop, say 3% below that. So if I take my 328.11, and I'm just using 3% as an example, times 0.97, 300, our stop would be at 318.26, so about $10 below. So if we're buying 73 shares, we're risking about $730. Well, actually, we're getting in at 353. Sorry, I was looking at this line here. So let me write down that stop, UNH, 318, 73 shares. Where we would actually be paying closer to 353. Now, we're going to assume we can get in for this 353.61, but it could go up tomorrow. So if we're risking $35 a share times 73 shares, that's right at our max of $25.80. So we're going to come to our trade tab. We're going to right click to buy custom with a stop. We're going to change our quantity to 73. And then I'm going to click this firecracker and turn it into a paper clip. And then when I click anywhere on these two lines, it will even the quantities up. And then we're going to put our stop at 318. And make this good till canceled. Now, if you want to give yourself a little wiggle room, it's saying the difference between the bid and the ask here is 353.70 and 353.99. It closed at 353.61. So this is saying, you know, that we're willing to pay up to 354. If you're okay with that, we can just leave that. Otherwise, you could adjust it and say, hey, I don't want to pay more than $3.50, $3.75. But what you'll want to do tomorrow is check when the market opens to make sure that it in fact got filled. And then we're going to put this in our stocks with dividends, because this does pay a dividend of 2.5%, even though we're buying it for growth purposes as well. We just want to remind ourselves that this also pays a dividend, and it's in the healthcare sector, which was something else that we wanted representation in our portfolio. We're now going to come and look at NVIDIA. Now, NVIDIA is the heaviest hitter on both the S&P and the NASDAQ. So it's a very influential company and a very influential stock. It just had a bit of a pullback, and so some might look at this as a chance for an entry. And it was down today. It just, announced a dividend, but it was down by a mere 16 cents, and it could continue to come down. So, could we put in a conditional order to say, hey, the high today was 180.28. If it goes 20 cents above that, you'd like to get in. So you could say, hey, I want to buy this stock only if it goes above 180.48. And how would you put that order in? And then how many shares could you buy? Well, if you wanted, you could choose just to buy 100 shares. If you wanted a $26,000 position, you could buy a few more. So, but for our purposes, we're just going to buy 100 shares. And we're going to make it a conditional order. And then where might we put a stop? Well, just to give it some room, and we might adjust this. We're going to look at our stops on a weekly basis. And again, a stop is not a guarantee that we're going to get out at the price requested. But we had this recent low at 164.07. And so you might put a stop. You might even say, I'm going to put it 2% below that. But if it starts coming down and it comes below here, then it's broken this support level. And others might say, I don't know that I want to risk that much. I see from a technician's perspective that, we had this diagonal resistance break. If it goes below this line around here, around this, call it 172.80, I'm going to put my stop 2% below that. And it's really a personal choice. The lower you put your stop, the lower the probability is that you'll be stopped out. But if you are stopped out, the more you could lose. So if I take that 172.80 times 0.98, we would have our stop at 169.34. And then we're going to come to our trade tab. We're going to look at buying custom with a stop. We're going to buy 100 shares. We're going to put that stop at 169.34. And then we're going to make it a market order. And it's like, what? Yeah, we're going to make it a market order. You can also do this. There are other ways to do this, but I find this the easiest way from my perspective to say, hey, if this goes above 180.48, then I would like to buy 100 shares. And why are we considering NVIDIA? Well, NVIDIA is a tech stock, and we're a little light on tech right now. Mainly because I was teaching this class in the first quarter when tech was getting clobbered. And so when we look at this, it's like we want to buy 100 shares of NVIDIA, but only if it goes up and goes up above 180.48, then it will trigger a market order to buy the stock. We want to sell if it goes below 169.34, and that'll trigger a market order to sell. So if it gaps above 180, we could end up paying more. If it gaps below 169, once we're in, we could end up getting out for a lower price. So it's just important that we understand that. And we're buying this because it's a growth stock. And you might say, well, it does pay a little dividend. The dividend is so little, we're not going to put it in our dividend bucket, but you can suit yourself. Now, what if you're saying, okay, so you're showing me the growth stuff. What if I want to earn a little income? So what I'm going to show you now, it's called a buy right covered call. And the idea, and not all buy rights are used this way, but we just had an earnings announcement, and they were expecting Zscaler to be losing money, and in fact, it made 89 cents a share. So it certainly beat on earnings, and what we're seeing here is a diagonal resistance breakout where, there's a bit of art in technical analysis. You may draw your line a little differently. So some might have drawn their line like this, where you're hitting more and said, okay, this is hitting more candles. It broke out, came back to retest, and is moving to the upside. But it is moving to the upside. And what if you said, well, I wouldn't mind buying 100 shares of Zscaler. What does Zscaler even do? Well, they are in the tech space, and tech has been strong, and it's a cloud security company. And so if we look at this and say, I wouldn't mind owning this for a shorter period of time. And so I call this a dating strategy. There is no ring involved with this one. We're going to be together for a few weeks, and then we're going to reevaluate. And if you end up like getting on a plane and going away, we're okay with that. So what do I mean by that? Well, it's trading at 286. The recent high was 318. Could we come and maybe sell the 310? Would we get enough premium for it to be worth our while? Something around here, sell a call and say, hey, it's trading at 286. If you'd like to buy this stock from me at 310, I'd be happy to sell it to you. Okay. Now, if it goes up to 330, how much are you going to get when you're called out? 310. And then you might be saying, darn, I regret having sold that covered call. But it's, $13.34 above where it's trading now. So let's come out to October and look at this 310 strike. Now, this is a stock that's pretty heavily traded. 2 million shares almost were traded today. Are we the first to have this idea? No, there are 339 contracts that were on the books when the market opened today for the 310 strike expiring in October. 200 contracts exchanged hands today. And you've got a 22% probability of this being in the money at expiration, which is calculated based on where it's currently trading and the expected move, which is $25. That's the one standard deviation expected move between now, either up or down, I might add, between now and expiration. So if we look at this and we say, well, if we did this, how much could we make? And maybe your goal, what you'd like to do is make like $2,500 a month, or you might want to make $1,000 a week. And could a strategy like this help you achieve that, where you want to be able to take a little money out, but leave, your base intact? So this, okay. Oh, this is, Sorry, I'm just refreshing my chat because I wasn't seeing anything. Okay, so we're paying $282.48 to get in if in fact we get filled at that price in the morning. And then what's the most we can make? Well, if we're called out on October 17th, 36 days from now, and we could be called out earlier. So what if the stock went up dramatically, tomorrow or Monday and we got called out? What would we do? Well, I would suggest champagne. I would not be crying about that because we're placing this trade because we'd like to make this bit of extra money. How big a bit could it be? Well, it could be 310 minus 282.48, assuming we get filled at this price. Times 100, $27.52 times 100 shares. And when we place this trade, we're willing to be in it for 36 days. If we get called out next week, it's like, yay, I got my $31,000 back. Now I've made my 27.51 and I can move on to the next trade. So sometimes people are afraid of being called out. Now, what's the downside? Well, the downside is the stock could go down. And then how do we want to protect ourselves to the downside? Well, we're going to look at where this, we saw this diagonal resistance breakout. So we might say, hey, I'm going to extend this line. I'm going to say, hey, if it comes back below this line, here's this line at 260. Yeah, I'm going to go 2% below that. If it goes more than 2% below that, man, it is not going in the right direction. So that would be 254.80. So, and again, no guarantee that you're going to get out at exactly the price requested. But if we come back and say, if we get out at, where did I put it? 254.80, call it 255. So 282 minus 255, just to give us an approximation, we're down 2,700. Okay, so we're risking 2,700 to make 2,700. It's like a 1-to-1 risk reward ratio. And, I had someone, I think we were at an event in Chicago, and he came up and he said, my goal is to make 6 figures in trading each year. I want to make 100,000 a year. And I don't know what his account size was. Like, I'm not a financial advisor. I teach people strategies, right? And I said, well, okay, that's about 2,500 a month, 10,000 a month, you'd be overachieving. 2,000, so that's 2,500 a week, or 2,000 a week, you'd be at 96,000 because 8 times 12 is 96. So if you aim for 2,500 a week, you'd be there and then some. So you'd want to place a trade like this. And I said, what strategy do you like? And he said, I like doing buy right covered calls, but I don't know how to protect myself to the downside. And I said, well, just put in an exit. He said, but I can't do that because I've got a covered call on. So let me show you how you do that. You come to your advanced orders, you change it to first trigger sequence. You come up here, you right click, you create an opposite order, and then we're going to make this a market order. Why are we doing that? Well, we don't know exactly how much we'd get paid for that option when we buy it back. So we're just going to place our exit based on the price of the stock. And we said, hey, if Zscaler goes below 254.80, we want to call it a day. Okay. So now we've got that in. You may want to come back and just read this. Make sure it says less and not more than 54.80, because if it says more than 54.80, as soon as the order gets filled, it'll end up getting you out of the trade. You tend to only make that mistake once. So we want to buy 100 shares of Zscaler, selling the October 17th 310 call, and we want to exit if Zscaler goes below 254.80. The most we can make, 27.52. Now, what if we get close to expiration and it's trading at 308? Well, we could just let it expire worthless. And then could we sell another covered call? We could. Or could we just decide to exit the position? We get to keep the value of that call. Now, what if it's trading at 315? So it's in the money and we haven't been called out. And just because you could be called out doesn't mean you will be called out. And maybe this position is worth $309.50. You have a week to expiration, so you have all but a thimbleful of your money. Might you choose to exit the position? You sure could. So just because you put in an exit, one, doesn't mean that you can't move it up. And two, it doesn't mean that you can't choose to exit the position. Maybe you have 2,500 of your 2,700 that you can possibly make, and you're going, you know what, that's good enough for me. So you do have choices as we go along. And James Boyd talks about that a lot in his classes throughout the week. Okay, so we're going to put this in our buy right covered call group. And this is our income generating strategy. Yeah, so could we roll it higher? Absolutely. We could roll it higher. So we're going to tee that up. Now, what do we do tomorrow morning? You know, what we do tomorrow morning is we make sure that these trades that we have put in actually fill, right? Right. Now let's come and look at Tesla. Just because we've got some extra time here today, I kind of hate to leave it on the table. So, you know, Tesla's been on the struggle bus this year. Like, it just took off like a rocket after the election, and, you know, and then it fell like a rock, you know, rolled down the hill with Humpty Dumpty. This is a 10-day moving average. And the 10-day moving average seemed to be acting as a ceiling for a little bit. And then it came up and bonked its head and had trouble getting past the 30-day. This black line is a 100-day moving average. So it kind of, you know, in April, along with so many other stocks, started to come up. And then it kind of was in this basing or consolidating pattern where we had higher lows, but we, you know, started having lower highs. And it has just recently broken above that. And today, you know, up 6%. And so when you have something that's up that much, you might want to come and look at the news, you know, and it's trading higher, you know, and this said possibly, you know, admit overall market strength and rate cut hopes. You know, he's lost 48 billion this year. Well, but you know, you may just want to, you know, scan the news. Like Sawyer Merritt posts that Tesla's received approval from the Nevada DMV to start testing robo-taxis on public roads. I did take is it called Waymo, a driverless taxi when I was in San Francisco, and I thought it was extremely cool. And I felt very comfortable in it. Now, my daughter-in-law was having 50 fits, you know, so, you know, people are just, you know, have a different feeling about that. But if you looked at this and said, well, I can see why you might be bullish on this. Let's go back to a 1-year chart. I'm not sure I want to be in this long term, but if I were to put in a target, you know, where might that be? Well, when something breaks out of a sideways range, Some traders will measure the size of the range. And so they'll come from here. Come on. Why does it not want to work for me? Say, okay, this is an $83 range. So I'm going to look at where this broke out here and add $83 to it. And so where did it break out? Here around 340. So if we add $83 to 340, a short-term target might be around 423. And so could we just buy some shares and put in a target at 423? We could. And what is that based on? The width of this pennant pattern or flag pattern. Okay. So, and again, can we buy 100 shares? We cannot. That would violate our position sizing rules, but we can take our 26,000 and divide that by our 369 and say we're going to buy 70 shares. And then where are we going to put our stop? Well, we're going to say, okay, here's around this 330, it's actually around 335. If it goes back below that, it's not heading in the right direction. And so if you said, I want to go 2% below that, so we're going to look at 70 shares. And our target was, oh, I've got a great memory, but it's short. What was it? Was it 423? Our target, 423. And our exit, our stop would be at 335 times 0.98 at 328. $328.30 if you want to get specific. So we're going to right click and buy. And here's an example. Here's our PE ratio on this one, 219.90. So are they still investing a lot of their profit in growth? Absolutely. But we're going to buy custom with a bracket because we're putting a target on this. And so this is another potentially income generating trade, right? Because we're not in this for the long term. We're in it to make a little money. And how long will that take? Well, we don't have a deadline on it, so we don't know. Could we lose money? We could. Was it 254.80? 328.30. And so if we're at 368, we're risking about $40 a share. So 40, 4 times 7 is 28. So we're in the right ballpark there. And then how much could we make? Well, if we said, if it hit our target of 423 and we're subtracting 369, that would, okay, I obviously did that wrong. And calculator reverse, 423 minus 369. That's $54 a share times 70 shares. $37.80. So again, you know, if it hits that, and then if it blows right through it and keeps on going, are we going to be sad? No, because our intention is, you know, to get in and to make, you know, an income. You know, and the difference between this and the buy right is that the buy right has somewhat of a deadline on it. We'll get to October 19th and then we'll make it, or October 17th, and then we'll make a decision one way or the other. Are we going to keep going? Might we be called out? Have we decided to roll the position? decisions will have to be made. And it's not that we won't make decisions along the way with Tesla, but one thing about buying a stock as opposed to involving an option is that we've got, we've got time. So we're going to hit confirm and send. And we're going to put this in our stock with a target so that we know we're not expecting, oh, this is saying we're risking 4,000 here. And that's a lot for us. And so we're going to come and change this. Whoops. We're going to change this to 50 shares and see what that gives us. So we're risking here now $40 a share times 50, so about 2,000. So maybe we could do 60 shares. Okay, let's come back and edit it one last time. Because we don't want to risk. Okay, so at 60 shares, our position size is 22,000 and we're risking about $2,400. Now, again, no guarantee. If it gaps up or gaps down, we could end up happier or sadder, on our exit. But that's another reason that it's so important to manage our position sizes appropriately. And this is another income strategy or shorter term investment strategy. And so we've teed up 4 trades today. And if we come to our monitor tab, just as we wrap things up, So today we placed an order on Tesla that was a shorter term. The intention is for this to generate income. So a trade on Tesla with a target, a buy right covered call on Zscaler, and then we added positions on UNH and NVIDIA to our account, one in healthcare and one in the tech sector. There is a survey in the chat. So if you click on that link, there are 2 questions. 1, I hated it. 10, I loved it, and everything in between. Plus, you have the ability to put comments in. So here's my promise to you. If you promise to fill it out, I promise to read each and every comment. I'll pass those on to Mr. Kevin Horner. He's on his way to Washington, D.C. He's doing a 2-day event with Mr. Ben Watson this weekend. So that's a wrap. Please hit the like button. It helps move this up in the algorithm so more people can find this content. Hit subscribe if you haven't done so already to subscribe to the Trader Talks from Schwab Coaching channel. And don't forget to follow James Boyd and I in the land of X, James Boyd CS, Barb Armstrong CS. And last but not least, have a really awesome evening. We'll see you all tomorrow for Trading a Smaller Account. Take care, everyone. Bye for now.